Okay, so let's just pause for a second today and appreciate the absolute absurdity of what we're looking at for this deep dive.
It really is something else.
Because I mean, I've seen flash crashes and, meme stock manias and crypto winters, but this is entirely different.
Yeah, this is unprecedented in a really weird way.
We are talking about billions of dollars of institutional capital just evaporating from the global logistics sector. Massive freight giants from Dallas to Denmark crashing. And the trigger for all of this.
Right, wasn't a war or a tariff?
Exactly. It wasn't a blocked canal. It was a company called Algorithm Holdings, which until 2024 went by a very different name.
The singing machine company.
They made karaoke machines.
Home karaoke machines, which is just incredible.
Right. We're talking about a company with a market cap of maybe $6 million. They have less than $2 million in revenue. They operated a net loss. But on Thursday, February 12th, they issued this press release claiming their new AI logistics platform could scale freight volumes by 300 to 400%.
Without adding a single new employee.
Without adding headcount. And the market reaction is just, it's insane. C.H. Robinson Worldwide, which is one of the biggest freight brokers on the planet, plunges 24% in a single day.
Just off a cliff.
The Russell 3000 trucking index has its worst day in ages. Billions wiped out because of a press release from a company that used to sell plastic microphones at Best Buy.
It sounds funny, and there is a dark humor to it, obviously, but this is actually a symptom of something much more serious. This is what we're calling the AI scare trade.
The scare trade.
Exactly. Because what we're seeing is Wall Street developing an autoimmune disorder.
Oh, that's a great way to put it.
Think about how an autoimmune disease works, right? The body's immune system gets confused and it starts attacking healthy tissue because it can't distinguish it from an actual threat.
It becomes hypersensitive and attacks the good stuff.
That is exactly what the market's risk system is doing right now. It can no longer distinguish between genuine existential disruption and a marketing press release from a karaoke company. So it just attacks everything. It's a dump first, analyze later mentality.
Which is why we need to unpack this today. Because if you're listening to this, our mission for this deep dive is to figure out how this scare trade actually works. We're going to categorize the 3 levels of actual AI exposure, from the very real to the completely delusional.
And most importantly, we're going to talk about how you can become a domain translator to save your own career from the fallout.
Because you could be collateral damage in this.
Yeah.
But to be fair to the trading algorithms here, this didn't just happen in a vacuum, right? The karaoke crash was really just the cherry on top of a very chaotic 10 days.
Oh, absolutely. This was a contagion. If you trace the timeline back, patient zero for this specific panic wasn't in logistics at all. It started over in the software sector about 10 days prior.
This was the Palantir earnings report, right?
That's the one. February 2nd, Palantir comes out and just obliterates expectations, 70% revenue growth. But the thing that really spooked the herd was their CEO, Alex Karp, claiming their tools could compress complex enterprise migrations into just 2 winks.
And for context, those migrations usually take companies like SAP or Oracle years to complete.
Years. Literally years. And that friction is the moat for legacy software. If it takes 3 years to install a system, you're never going to leave that system.
Right, the switching costs are too high.
Exactly. And Karp was basically saying, we can drain your 3-year moat in 14 days. So the market heard every company selling software seats is repricing.
And then literally the next day, on February 3rd, Anthropic releases these new legal plugins for contract review.
And that is when the floor fell out completely. A trader at Jefferies actually coined the term the SaaS apocalypse. Within 48 hours, something like $285 billion vanished from SaaS, legal tech, and data analytics stocks.
$285 billion.
Just gone. The market looked at Anthropic's ability to read a contract and said, okay, legal tech is dead. Data analytics is dead.
And it spread like wildfire from there. Looking at the sector map we have, it's fascinating how the logic jumps from industry to industry. It hit private credit next. Firms like Ares, KKR, Blackstone, they all dropped 8 to 10%.
Because the market suddenly decided AI can analyze loan portfolios better than human analysts.
And then it jumped to insurance. A company called Insurify releases a rate comparison tool, and suddenly the S&P Insurance Index has its worst session since October. Then wealth management gets hit. Raymond James and Schwab tanked 7 or 8% just because a startup called Altruist launched an AI tax tool.
And don't forget real estate.
Real estate, that one seemed particularly brutal to me. CBRE and GLL dropping 12 to 14%.
Well, the logic chain there is brutal but simple in the market's eyes. AI reduces headcount, which reduces the need for office space, which kills commercial rent. So in 10 days, we saw 8 different sectors burn down, and the pattern is identical every single time.
A press release comes out, and the incumbents crash immediately.
Exactly.
It's fascinating, but it also feels incredibly dangerous. Because like you said, this is an autoimmune disorder. The market is hurting healthy companies. But here's where it gets really interesting for anyone working at these places. These stock drops aren't just numbers on a screen.
No, they have very real consequences. There's a concept in finance called reflexivity. It's basically the idea that a stock price doesn't just reflect reality, it can actually create reality.
Meaning the market crash causes the business to fundamentally change.
Yes. Think about C.H. Robinson. Their stock drops 24% because of the karaoke guys. That isn't just a bad day for their shareholders. That triggers an emergency board meeting the very next week.
And then what a hiring freeze the month after.
Exactly. It forces the CFO to rip up the Q2 roadmap and rewrite it around some vague AI strategy, whether they actually have one or not.
So they go into a defensive crouch.
They are forced into performative measures just to appease the investors. They cut costs, they slash product teams, and they sign these splashy, expensive AI partnerships just to look busy and show the market they get it.
Which is incredibly ironic. By gutting their actual product teams to save money and chase this narrative,
Yeah.
aren't they making themselves more vulnerable to actual disruption down the line?
That is the ultimate paradox here. They are reacting on a market time scale, which is measured in hours and days, when they should be reacting on a business time scale, which is measured in years. They are cutting the muscle to save the fat.
Right.
And in 3 years, the companies that gutted their teams to survive this scare period are going to be the ones that actually get disrupted because they stopped investing in organic growth.
So if you're listening to this and you're seeing this chaos unfold, the big question is whether the market is wrong or just early. Because let's be honest, tools like Cursor or GPT-4 are incredibly powerful. Maybe some of this fear is justified.
The market is right about the direction, but it is catastrophically wrong about the precision. It's hitting a fly with a sledgehammer right now. To really understand this, we have to peel apart the 3 distinct categories of AI exposure. Because Wall Street is treating a coding editor and a freight truck as the exact same thing.
Okay, let's break these categories down. Category 1, this is where the fear is actually justified, right?
Yes. Category 1 is genuine displacement. This is mostly isolated to SaaS and coding right now.
This is where we see tools like Cursor.
Right. Cursor is an AI coding editor, and it hit $300 million in annualized revenue faster than almost any product in history. Then you have companies like StrongDM. They are talking openly about paying for AI tokens rather than hiring developers. They are operating with a tiny engineering staff.
So in this category, the old business model of selling software per seat, where you need a human in every seat, is fundamentally broken.
It is in serious trouble. If software bottlenecks on human output and AI removes that bottleneck, the business model breaks. It is highly deflationary. You simply don't need 50 seats of a CRM if an AI agent can do the work of 50 people using one API key. So when those specific stocks drop, the market is actually pricing them correctly, even if the speed of the drop is a bit aggressive.
Okay, so that's the danger zone where the disruption is real and present. What about category 2?
Category 2 is what we call the 3 to 5 year horizon. This includes sectors like wealth management and commercial insurance. Here, the market is right about the direction that AI will change these fields, but it is completely wrong about the speed.
This is the Schwab and Raymond James drop we talked about.
Exactly. The market thinks an AI tax tool replaces a wealth advisor next quarter. But the value of a wealth advisor isn't just doing the math. A basic calculator has been able to do the math for 30 years.
So what's the actual value keeping them employed?
It's behavioral coaching. It's the human relationship. It's the trust required to keep a client from panic selling their entire portfolio during a downturn.
Which, ironically, is exactly what the wealth management investors were doing with the wealth management stocks.
It's pure poetry, isn't it? And the exact same logic applies to commercial insurance. That involves complex negotiation and nuanced risk assessment. It is not just comparing rates on a slick website. The market is pricing a gradual 5-year transition as if it's happening before the next earnings call.
Which brings us to category 3. This is the lost the plot category.
The totally delusional category. This is logistics and real estate. This is where we go back to our karaoke company.
The idea that a press release can just undo a global physical supply chain.
It's laughable. C.H. Robinson has 100,000 shipper relationships. They navigate incredibly complex customs regulations, physical borders, truck maintenance, warehouse logistics. A piece of software, no matter how good it is, cannot overnight replicate the physical complexity of moving heavy goods around the planet.
I saw a great quote from a group analyst regarding algorithm holdings. He said he was skeptical that a karaoke company would disrupt global logistics, which he noted was being very kind.
Very kind indeed. But this is where the real opportunity lies for investors because the market is panicking. It's creating a generational buying opportunity in these Category 3 sectors. The physical wealth is not going to be automated away by a chatbot next week.
So we have this massive disconnect. The market is screaming fire in a crowded theater, and in some places like Category 1, there is a real fire. But in other places, it's just a picture of a fire held up by a karaoke singer.
That's a perfect way to visualize it.
But let's bring this down to the individual level for the listener. Because if a $6 million karaoke company can crash a sector, it feels like no job is truly safe from the narrative of AI.
That is the key word, narrative.
Because even if the tech can't actually do my job, yet my CEO might think it can.
Precisely. And that is the personal risk you face here. If layoffs happen right now, and they are happening, they aren't being based on a rigorous, careful analysis of whether AI can do your specific job. They are being based on whether your department is a cost center at a company whose stock just dropped 15%.
So if I'm in operations or HR or legal, and my company's stock takes a hit from the scare trade, I am in the blast radius, regardless of my actual utility.
You absolutely are. And specifically if your job is centered around synthesis. If you spend your day summarizing meetings, aggregating reports, or synthesizing information from one format to another, you are in direct competition with AI. And the scare trade has just made your CEO painfully aware of that fact.
Okay, that's the scary part. But we promised the listener a survival guide. You talk about this concept of the domain translator. What exactly is that?
This is the single biggest career opportunity in the corporate world right now. The domain translator is the person who can bridge the gap between the whiz-bang vendor promises and the actual messy realities of business workflows.
Because the CEOs are panicked.
Right.
They have genuine fear in their eyes.
They are terrified. They have a board demanding an AI strategy immediately. They have vendors selling them magic beans, and they have no idea what actually works in practice. They need someone who can walk into the room and say, I have tested this, here's what Claude or GPT-4 can actually do for our contract review, and here is where it hallucinates and makes things up.
That sounds incredibly valuable to a panicked executive team. So how does someone actually become that person? Because just hearing learn AI feels like such generic advice. That's so 2024.
It is generic, and it's not enough anymore. You don't need to learn AI in the abstract. You need to apply it locally. Here is the exact action plan you should follow. Take a specific repetitive workflow in your own domain. Maybe it's an HR screening process or a legal compliance check or a supply chain routing issue.
Something you already know inside and out.
Exactly. Then run a parallel process. Do the task manually the way you always do it, and simultaneously try to do it with AI. And track the results religiously.
So you're basically building a proprietary data set for your specific job.
Yes. You want to be able to go to your boss and say, look, I tested this new tool. It handles 70% of the cases accurately. It fails completely at these specific clauses. But if we add a human check at this exact stage, we can save 40% of the time.
Wow, that changes the conversation completely. You aren't just a worker bee anymore. You are a strategist.
You move straight from the layoff list to the transformation task force. You become the person validating the strategy for the board. Because right now, companies are going to spend money. They are desperate to spend money on AI to show Wall Street they are evolving. The question is, are they spending it on blind software licenses, or are they investing in the people who can actually make that software work?
That is such a crucial distinction. It's all about leveraging the asymmetry of this moment.
It really is. The scare trade is essentially a massive transfer of career capital.
Yeah.
It deeply hurts those who are just coasting on process the synthesizers, but it massively rewards those who can combine deep domain expertise with practical AI fluency.
It's funny when you think about it, the panic is actually speeding everything up.
It is. I strongly believe this panic has accelerated enterprise AI adoption by years because it forced AI onto every single board agenda simultaneously. It doesn't even matter if the karaoke company's tech was real or not. The market's reaction to it has permanently changed corporate budgets globally.
That is the ultimate irony of this whole story. We started with a $6 million karaoke company crashing a global industry. And the takeaway isn't just that the market is irrational, though it obviously is. The takeaway is that this little karaoke company didn't just crash a stock. It likely accelerated the actual AI transformation of the logistics industry.
By scaring the massive incumbents into action.
Exactly. They scared them straight. The market is wrong about the now. It's wrong about the karaoke company today, but by panicking, it ensures that the future happens much faster. The defensive crouch eventually turns into a sprint.
And if you are an employee in that environment, you cannot afford to be passive. You have to be the one testing the tools.
So that is the homework for everyone listening. Don't just read the headlines and roll your eyes at the karaoke crash. Test the tools in your own domain. Don't let a fake press release determine your career stability. Become the domain translator.
Couldn't have said it better myself.
We'll leave it there for this deep dive. Definitely go check out the sources if you want to see the market charts for yourself. They are truly something to behold. We'll catch you on the next one.